My name is Vinod Tharakan. I'm the chairman and managing director of ClaySys Technologies in India and CU NextGen in the United States. We have been servicing the banking and financial services industry in the United States for the last 30 years or so. Uh, this is responses to questions from the Open Magazine. The first question was, can India become an economic superpower in the next 20 years? And if so, how can we do it? So the important thing to understand about the economy is what drives the economy is the GDP, the gross domestic product, or the total value of the goods and services created within each year or within each 12 months. And what limits the goods and services that are created and consumed within the economy is the total quantity of money created within that country. So India has a certain amount of Indian rupees floating around within our economy, and the quantity of that Indian rupees is what finally decides the total consumption capacity of the country for the goods and services produced within the country. The challenge we have is if we look at our monetary system in India, uh, there seems to be a disconnect in the understanding of how this money is created. So if you look at India and China, we were almost the same in the 1990s, both in terms of our GDP. China was marginally bigger than India. But if you fast forward to today, the Chinese GDP is about 18 trillion US dollars, and the Indian GDP today is about 3.75 trillion dollars approximately. So what drives this is, again, the quantity of money in the system. And what the parameters that decide the quantity of money in the system is the money created. And the money that is created within an economy, in a modern economy like India or the Western countries, is about 90% of the money that's created is created through the banking system. New money comes into existence through every single bank loan. And as the bank loan is repaid by the borrower, the money that is created is sucked out of the system. So if you look at the problem in India, India only has about 33 commercial banks that contribute to about 92% of all the lending in the country. China grew from one bank, the People's Bank of China in the 1980s, to having more than 4,250 banks today. The United States has about 10,000 banks today. Germany has 1,800 banks today. So India is not creating money at scale through the banking system. And again, there seems to be a disconnect in India in relation to how we manage inflation. Inflation is the increase in prices of essential items like food, medicines, consumer goods, and such, housing as well. Now, the factors that contribute to inflation is not the total quantity of money, but is a scarcity of the products themselves. So, for example, if there is a scarcity of toothpaste or if there's a scarcity of food, the prices of tomatoes, onions will all go up. So the pricing for the goods that contribute to inflation is defined not by the demand of the total quantity of money, but rather by the supply of these goods and services. All essential items have a fixed demand in the economy. And so we do not need to worry about inflation if we create money for productive purposes. And of course, if we have enough supply of essential items to meet the fixed needs of the people for all the essential goods and services. So what's happening in India is we need to be creating money at scale by revamping the financial system, by having banks, a far larger number of banks. And we need to be lending this money out at extremely low interest rates. I would almost say the interest rate should not be exceeding 2% to make it easier for the borrower to repay these bank loans. And if we create bank loans for productive purposes, a productive loan is a loan where the money comes into existence and is offset by the creation of a goods or a service contributing to the GDP, such as a new house, a new car. So if these new loans are created with new money that are offset by contributing productive output to the GDP, we can create money at scale without inflation. So that is how we need to do it. And we need to have a larger number of debates and discussions on the banking and monetary system in India. The second question is how can financially empowering panchayat system in India, how can that really empower financial growth of the economy? So this is a very interesting situation in India. We have 250,000 panchayats, And these panchayats are the local self-government entity that takes care of the needs of the local population across the country. We believe that India should create money at scale by giving every single panchayat a limited banking license to create money through lending at very low interest rates, expressly for the purpose of creating immovable assets within the panchayat. So what is an immovable asset? The immovable asset is the creation of a house, a shop, a little workshop, a small factory, uh, a small industry like a dairy farm or a chicken farm, uh, any physical asset, immovable asset within the panchayat, if that is enabled to be created through bank loans funded through panchayat bank lending, I think it'll change the game because we will have 250,000 panchayats now competing to attract borrowers to come and invest within their panchayats. And if the panchayat has a skin in the game through earning some income through the interest rates, let's say the interest rate of a panchayat bank loan is 2%, and if the panchayat is going to get 1% out of it, every single panchayat is going to be incentivized to attract the borrowers. The borrowers are going to come in, they're going to create productive assets or within each panchayat, and money is going to be created offset by these immovable productive assets that in turn can then fuel the growth of the rest of the economy. So I think the idea of empowering every single panchayat in India to have a limited banking license will be a true innovation that could create money at scale for productive purposes and boost the economy at the grassroots level, meeting the essential needs of the people of this country. The next question is, to what extent do the small businesses, small and medium-sized businesses, result in growth of the economy? So this is a very interesting situation, right? And if you look at the modern economies around the world, about 60 to 70% of all the jobs created are created by the small to medium-sized enterprises. And it's the small to medium-sized enterprises that create most of the jobs and also create most of the innovation within the country. The problem, though, is when you start looking at the root of how money is created through the banking system, the big banks only have an interest in lending to large corporates or big companies. It is a small bank, so the community level banks that are more inclined towards working with small businesses and lending to small businesses. So if you couple a panchayat banking model like we touched on, where you use the panchayat lending model to create immovable assets within the panchayat, and then you expand the banking system to have small and medium-sized banks at scale across the country, working with small enterprises and small businesses. I think we're going to really enhance and boost the small business sector within the country, increase job creation at scale, and exponentially boost our economic output or GDP. The next question is whether India should only focus on services and not really focus too much on manufacturing, as many of the leading economists are talking about, under the pretext that the manufacturing game has been won by China. I feel this is, again, a significant disconnect from how an economy should function. India has a major domestic need for goods and services that can only be satisfied by boosting our domestic manufacturing to meet our domestic needs. So I think it's completely off base to claim that India should only be focusing on services. We absolutely need to focus on manufacturing. And I think the Make in India initiative is a huge step in the right direction that needs to be fueled further through money creation at scale, supporting productive output. So I would say, just like a human being has essential items, which is what we track for tracking inflation, even a country has a list of essential items that it needs to ensure it has domestic capacity for. And that can only be done by boosting the manufacturing sector as well. So I absolutely disagree that India should only focus on services. I think there's a massive demand in India for domestically manufactured goods, and we really need to support the manufacturing base in India as well. The last question here is, what are the lessons that India should try to learn from China, and what are the lessons that India should not learn from China? So I would say one clear lesson that India should learn from China is how to create money at scale for productive purposes. It is important to understand that the total money supply of the United States is 21 trillion US dollars, compared to the total money supply in China today, which is about 40 trillion US dollars. So China has double the money in terms of purchasing power in US dollars than the United States has. And that is why we are seeing the Chinese Navy now becoming bigger than the US Navy and such. So money creation at scale for productive purposes, China is doing a great job there. And there are a lot of lessons that India needs to learn. China went from one bank in the 1980s to 4,000 plus banks today. India went from 600 banks to 33 banks today in terms of the commercial banks contributing to the significant portion of lending. In terms of the lessons that India should not learn from China, I think we should focus on the free market, by which I mean that we should not have too much of centralized control. We should allow the market to invest into the creation of goods and services and fuel that through productive bank lending. And we need to ensure that through the free market process, we have all the transparency in the system to ensure that we do not have wasteful creation of money towards purposes that are not in the best interest of the people. So that is what I think we should not learn from China.